The problem from this video can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link and you can download a copy of this and all of my problems for yourself. Now, if you check the website and you click on videos, you'll see there are more videos than those I've listed publicly on YouTube. You can see that there's every problem covered in the workbook has either a public video or a members only video. If you'd like access to the members only video, just click the join button beneath the video player on YouTube. All right, let's jump into the problem. In this video, we are going to explore problem 22A. This is a very important video. It shows us how to do journal entries. In the second part, we'll make T accounts, and finally, we'll do a trial balance. As mentioned in my previous video, though, if you don't understand journal entries, you will be in trouble in an intro financial accounting course. So if you haven't watched the intro video for this module, please watch it. We go over the rules of debits and credits, when we make a debit and when we make a credit, but there's this little cheat sheet I'm going to keep referring to on the side of my page. I encourage students to write it in the corner of their exam papers. And here's the rule. If we have an asset that's increasing, we debit it. If we have an asset that's decreasing, we credit it. Liabilities are the opposite. Debit them to make them go down, credit them to make them go up. Shareholders' equity, same as liabilities. Debits make them go down, credits increase them. Now, because of the way revenues work, revenues always help our shareholders' equity, so revenues always take a credit. Expenses and dividends always hurt shareholders' equity, so they make shareholders' equity go down. They take a debit. So those rules are going to hold here. Let's go through the problem and see how we do. In August, Maria Chen started her new taxidermy business, The Right Stuff, Inc. The business focused on preserving family pets after they passed away. The following transactions occurred during August. Okay. August 1st, Maria invests $1,000 cash in exchange for 250 common shares. Now remember, Maria is separate from her company, The Right Stuff Inc., and we are the accountants for the company. This class is all about corporate accounting, so we are looking at this from the company perspective. And the first question I always ask when I think of these journal entries is, did any money change hands? Did cash change hands? And the answer is yeah, $1,000 of cash changed hands. So Maria invests $1,000 in cash in exchange for 250 common shares. Now, this is Maria starting her company. She's buying the initial shares just to begin the company. The company is getting cash, and Maria is getting common shares in this transaction. So the company is getting cash. So looking over at this table on the left, cash is an asset. The company's cash is increasing, therefore debit cash. So let's do that. I'm going to date this because it's a journal entry, Aug 1. And then under August 1st on the left, I write cash and DRCR headings up here. We're going to debit cash for $1,000. I don't put a dollar sign there. Now, what's the other piece of this? Well, she invested her $1,000 of cash in exchange for 250 common shares. This one is a little confusing as a first entry, but just know that her equity in this company is growing, right? Common shares are one of our two equity accounts we're worried about here. So this is absolutely shareholders' equity. And before, she had no piece of the pie. Now she has a $1,000 piece of the pie. So her shareholders' equity is growing. Sometimes students can tie themselves into knots here thinking, oh, common shares aren't those assets and are our assets going down? No, common shares are always an equity account for us. Her equity is increasing. So let's credit common shares. $1,000. Now, something that many professors will require, I don't, is to write a description. If you wanted to write a description for this, you would say Maria invested $1,000 cash in exchange for 250 common shares. You would just write this underneath. One other question I frequently get here is this number, this 250. Why haven't I written 250 anywhere in here? And the reason is journal entries are all about the dollar amounts. So again, if I bought 4 cars for $10,000 each, I would go debit car 40,000. I wouldn't go debit car 4, right? because there's 4 cars. Well, here there's 250 common shares. The number of shares doesn't matter. It's the dollar value that's being exchanged. So there we have it. August 1st in the bag. I'm going to try to work a little more quickly because that was 4 minutes for one entry. Let's move faster. Next, rented workspace, paid $600 for the month of August. Okay, so first thing, paid $600. That's telling me cash is changing hands. So on August 1st, I'm going to credit cash. I'll leave room for a debit here. And I should be clear here, cash is, of course, an asset, and it is an asset that is decreasing. That's why I'm crediting cash. I credit cash for $600. I don't need to write DRCR on every entry. It can sort of follow through for the rest of the page. Now the debit here is a debatable one. I think the most logical one most companies will use is they'll say, look, this is a cost of doing business. Rent is an expense, so we should debit rent expense. And I do think that's the most logical choice. However, if companies pay for multiple months of rent in advance, certainly prepaid rent is not an unreasonable thing to say here. Prepaid rent is actually an asset account. We'll learn all about it in Chapter 3. But for now, I think rent expenses is logically what most companies would do. And so that's what we'll do here. August 2nd. The company borrowed $500 in the form of a long-term bank loan. The money was planned to purchase much of the equipment that would be needed. Okay, so first of all, whenever it talks about the money being planned for something, who cares what the plans are, right? Plans fall through all the time. This is financial accounting. It's all about what happened. It's not about what's planned to happen. That's a managerial accounting thing. Financial accounting is like, just give me the facts. What happened? So what happened? We borrowed $5,000. So did money change hands? The answer is yes. We got cash. We received cash. So cash, again, is an asset. It is an asset that is increasing. Let's debit cash. So August 2nd, we'll write cash on the left here, and the amount was $5,000. The credit, well, what's the other piece of this? It's long-term bank loan, right? We have a liability here. Yesterday we had 0 bank loans. Today we have $5,000 worth of bank loans. Our liability is indeed increasing. That means we need to credit bank loan or bank loan payable. I always like the word payable at the end of my liabilities. Whoa, something crazy just happened. Payable. There we go. $5,000. Okay. I think we're doing well. Let's continue on to August 5th. It's a funny thing making these videos because in class I would always pause and say, oh, does anyone have any questions? And there might be a question or two and I'd keep going. But in the videos, there's nobody to ask questions. So I try to come up with typical student questions. But that one, I think that's straightforward. Purchased equipment, $4,000. Paid $1,000 with the rest payable at the end of August. Okay, so we bought some equipment. We bought $4,000 worth of equipment. Cash did change hands, so let's deal with that. Paid $1,000. That's all I need to see. So I'm going to date this August 5th. We've got an asset that's cash, and we've got an asset that's decreasing, so therefore we'll credit cash. So I'm leaving room for a debit because I know one is coming, but let's credit cash for $1,000. Let's deal with the equipment because we did acquire $4,000 worth of equipment. So the fact that we got $4,000 worth of equipment means our assets, our equipment assets, are indeed growing. So our equipment assets are going up. Debit equipment. And they're going up by $4,000. Like even though I only paid $1,000, I got $4,000 worth of equipment. And so debit equipment for $4,000. Well, what's the other $3,000? Clearly, I'm missing a $3,000 credit, but what is it for? Well, let's see. We purchased equipment $4,000, paid $1,000. The rest is payable at the end of August. Okay, the payable amount. This is us doing a business-to-business transaction. We owe somebody some money at the end of the month. It's a bill to be paid. Bills to be paid, of course, are liabilities. They're something you owe. And it's increasing, right? Yesterday, I didn't have any bills to be paid to this company. Now I have $3,000 worth of bills to be paid. So we are going to credit our liability. Now, what's the liability? It's accounts payable. AP is our typical bill to be paid. Again, if I were writing a description, I would literally just write this underneath. I'm not going to say that every time, but I just want to reiterate that if you are in a class that requires descriptions of you. August 10th. Received and completed first taxidermy job. A poodle named Rex. Received $400 cash. Okay, this is us doing work, right? We are doing our service. We are doing work. And this is us earning money. And in fact, cash did change hands. So let's deal with cash first. It's an asset. It's increasing. Therefore, debit that asset. Let's debit cash on August the 10th. Cash goes up by $400. Now, what's the other piece of this? Well, it's us earning money. And when I think earn, I think revenue. And that's exactly what this is. This is taxidermy revenue. And of course, we expect to see this be a credit, and it is a credit of $400. Next, purchase supplies on account, $200. Okay, let's scroll this down. Maybe even further. Purchase supplies on account, $200. Okay, so we got some supplies. We didn't pay cash though. So if we buy something on account, this creates a liability. We owe, right? We said, hey, we'll take those supplies. Send us the bill. And when we say send us the bill, what we're saying is give us an account payable, right? Let us have store credit. Let us have credit with you. Purchase supplies on account. So supplies changed hands, and there's this asset called supplies. We acquired some assets. So the supplies assets are going up by $200. Let's debit on August 12th. Let's debit supplies by $200. The credit here is to accounts payable. This is a normal business-to-business transaction. It's, a liability. It is increasing. Therefore, we credit that liability. Okay, let's continue on to August the 13th. Completed second taxidermy job. Easy for me to say. A chocolate Labrador retriever named Kit Kat. $600 on account. So we did some work. We didn't get any money. We sold it and we sent our customer a bill. Okay. So this is clearly a revenue earning situation. Maybe we'll deal with that first. We'll have to credit some sort of a revenue. So on August the 13th, I'm going to credit taxidermy revenue, right? I did some taxidermy work. I'm earning taxidermy rev, and the amount is $600. The debit here would normally be to cash when you're earning money, but we didn't get paid. So when a customer owes us money, it's sort of like when we owe our vendors money, it's accounts payable. When a customer owes us money, it's accounts receivable. Debit, AR, accounts receivable for 600 smackers. Okay, continuing. Took a dividend of $500, I think it's implied cash, to pay for personal expenses. So Maria takes a dividend, $500 cash to pay for personal expenses. Doesn't matter what she wants to pay for. We just know she took $500 cash from the company. So cash is changing hands here. Let's credit. It's an asset, of course, and it's going down. So let's credit cash on August 14th. Cash takes a credit of $500. The debit is, well, what did she take? She took a dividend, and dividend is its own class here. Now, your prof might teach you to debit retained earnings, and we'll talk about that later, but that's totally appropriate. If you've learned to debit an account called retained earnings at this time, totally an appropriate thing to do, totally fine. I debit an account called dividends in my classes, so we'll do that, and we'll explain why in the future. Chapter 3, Module 3. Received and paid the utilities bill, $200. Okay, received and paid. We paid a bill. If you pay a bill, that means money's going down. We got an asset. It is decreasing. Credit that asset, and that asset, of course, is cash. August 19th. Cash goes down by $200. The debit is utilities cost. This is a cost of doing business. This is an expense of our business. Debit, utilities, expense, 200 bucks. Next, paid for the August 5th equipment purchase. Okay, paid. Already when I read that, I don't even need to look up. I know I'm going to credit cash for some amount, right? This is August 20th. And why am I crediting cash? Well, again, asset decreasing. Credit that asset, and cash is an asset decreasing. Let's go back to August 5th, figure out how much. It was, okay, so this is interesting. Paid $1,000 with the rest payable. So we're paying not the full amount. We're not paying $4,000. We're paying off the $3,000 that was payable at that time, right? We've already paid $1,000, so we're not going to pay another $4,000. We'll pay $3,000 here. Now, a frequent mistake here is because students go, oh, they're paying for equipment, debit equipment. No. We're paying off a debt. We're paying off a bill. We are reducing that payable liability. If I debit equipment, it would be like I bought $3,000 of new equipment here. Didn't do that, right? It's paying a debt. We have this account payable. This account payable says we owe them $3,000. What we're saying is I don't owe them that money anymore. My liability, my payables liability needs to be reduced. It needs to go down. Debit accounts payable. $3,000. Okay. Next, August 21st, received a telephone bill, $200, did not pay it yet. Okay, so we got a telephone bill. If we paid it, we would credit cash. But since we didn't pay it, obviously this creates a debt or a liability, an account payable in this case. Let's deal with all of this. August 21st. What is a telephone cost to a business? Telephone cost is absolutely an expense, and expenses need to be debited. Let's debit telephone expense and the amount, I almost put a comma there in $200. It's interesting. This is a random aside here. I teach at a university where there's students from all over the world, and not everybody puts commas in the same place is what I've discovered. Some European people would put like that, comma up top. Students from India have all sorts of different places to put commas. But of course in North America, it's like 3 zeros, a comma, 3 zeros, a comma, etc., etc., etc. Okay, anyway, we've debited, weird aside, we've debited telephone expense. What's the other piece of this? Well, it's a liability we're going to have to pay back. It's an account payable. And yesterday I didn't owe the phone company anything. Today I owe them $200. So credit AP, $200. Next. Received payment for the August 13th job. I think that was our chocolate Labrador Retriever. Let's see, August 16th. What date was it? August 13th. This one, yeah, this one over here. Okay, so yeah, we did some work, $600 of accounts receivable, and now the person's coming in to pay. So, of course, when they're paying us, we debit cash, $600. August 24, debit cash, $600. A common mistake here is to credit taxidermy revenue because they're paying us related to taxidermy work. No, we've already recorded the taxidermy revenue up here. What we've got to say is this account receivable, it's no longer receivable, right? We've got the money now. We don't have to collect from this client any longer, so we don't need to track them as a receivable, as an amount owed to us. So we get rid of that asset. We reduce the accounts receivable, which of course is an asset. It's decreasing. Credit AR. A lot of these ones where I debit cash, I just know the other one's a credit because that's how journal entries work, right? We need equal amounts, debits and credits. So clearly we're going to be crediting something for $600. Completed a third taxidermy job, a calico cat named Spot, $250 received payment. So we got paid. Anytime I get paid, I debit cash. Let's do that. Cash, $250. What's the credit here? Well, the credit is to what is it to taxidermy revenue? I had like a real blank there. I was like, oh, I'm almost to the bottom and I haven't made any obvious mistakes. I was so happy with myself and then I totally blanked. We're going to credit taxidermy revenue though. This is a company doing what it does to earn money, and they do taxidermy to earn money. So taxidermy rev, 250, and we're almost there. Paid salaries of $1,000. Salaries again are a cost of doing business. That's an expense. And whenever I read paid, I think, okay, cash, my asset is decreasing. So let's I hexed myself. Cash is decreasing. I circled the wrong one. I'm going crazy here. Let's credit cash here. How about that? Good grief. It was going so well, and then I commented on how well it was going, and the wheels fell off. We paid salaries, credit cash for $1,000. You guys all knew it already, for goodness sakes. The journal entry here, though, this is a cost. This is an expense. This salaries are an expense. So debit, salaries, exp, $1,000. Just a quick note about this. So we've gone through the journal entries. We have answered part A. In the next video, we'll do B, and then following up video, we'll do C. But a quick comment before I close this out on this thing. I always teach with this in my classrooms, and it's, I think, useful, and I think it's good, and that's why I do it. But I'll never forget, I had a student at the end of one semester, and he said, hey, you taught us this chart, and I didn't understand it. Why didn't you teach us dead curls? And I was like, what's dead curls? I don't even know what you're saying. And he said, yeah, dead curls. And he writes this on the board, DEADCRLS. And I was like, I'm sorry, I have no idea still what you're talking about, dead curls. And he goes, okay, look, debit, expenses, assets, dividends, credit, revenues, liabilities, and shareholders' equity. And it's all true, right? A debit to expenses makes the expense go up. Debit to assets makes it go up. Debit to dividends makes it go up. And the reverse is true, right? If I credit an asset, it makes it go down. Same with credits. Credit to revenue makes it go up. Credit to liability makes it go up. Credit to shareholders' equity makes it go up. And just know that the reverse is true. So I thought that's a useful trick. I'm not going to refer to that. But if you were feeling like, I'm a little bit feeling weird about that, maybe dead curls will help you. And the final thing that won't help you, but it'll help me, is if you got through to the end of this video, you heard all the tips. Somebody told me I have to do this. We'll see if it works, if it makes a difference, if it makes the YouTube algorithm favor me. I really would appreciate a thumbs up, though, if you made it to the end. Let me know in the comments that you survived. You're seeing the end of this video. I think most people tune out after about 5 seconds, but if you made it to the end, congratulations and thank you for being here. Regardless of if you like or subscribe or dislike even, I do want to thank you for being here. All right, stay tuned for our next video. We'll just continue on this journey.